passively managed mutual funds and ETFs in the US, which basically attempt to mimic the performance of underlying market indices, have for the first time in history reached a point where they have more assets under management than the active funds. So what does this broader movement from actively managed funds to indexation mean for those who still want to actively pick individual stocks to outperform the market? Is this the end of active stock picking, or is this the end of outperformance? I'll discuss all of these questions and the broader implications of this fundamental shift in this video, so make sure to stick around. Let's get started. Alright, hi there, my name is René Zellman, and as I already hinted at in the intro of this video, passive seems to be taking over. So let's have a quick look at the data. So as this chart here shows, after steadily coming closer to active funds, year after year, passive funds closed 2023 for the very first time with more assets under management than the actively managed counterparts. And this certainly was to be expected, because if we now take a look at another chart, we can see that over the years, US equity fund flows have long favored the passive products, the ETFs, the indices. And so it only made sense that the green line in this chart here, representing the passive assets under management, steadily approached the orange line representing the actively managed funds. And for most people, this shift from actively managed funds, which often charge quite high fees for very poor results, that they shift to passive products, broad market, low cost indices or ETFs. This was the advice of John Bogle, the founder of Vanguard, and more people are following his advice. So I was just saying that you often pay high fees for actively managed funds for relatively poor results. So let's again support this claim by looking at some actual data. So I looked at the most recent mid-2023 report by the S&P Dow Jones Spiver, I think that's how you pronounce it, research. So what this table here shows is that the longer you extend the investing horizon, the lower the chances of your actively managed fund or funds beating the corresponding benchmark. So if you just, for example, take a look at the column looking at the 10-year performance, if you look at all domestic funds, only around 13.9% of those actively managed funds managed to beat the market. And yeah, so if you ask me, this development, that shift to passive, is very likely to continue. So just to look at the bar chart we already looked at again, as you can see, this trend has actually accelerated over the past decade. And so my prediction would be that the green line will certainly surpass and continue to widen the gap relative to the orange line and the line chart. And just to wrap up the discussion about all of the relevant data here, let me just show you another chart. This one here highlights that 2023 was actually a year during which the US fund industry saw relatively little inflows. So I would not be surprised if that trend will accelerate over, say, the next few years once we see larger fund inflows again. And obviously, this is a big challenge for the active investing industry. We already see companies cutting significant number of jobs, and this trend likely will also continue to persist. Okay, but now we get to the more interesting part of this video. What is the consequence, or what are the consequences of this fundamental shift in the investing world? Is this a bleak outlook for those who want to actively pick stocks in order to beat the market? Or can stock pickers actually fight this rise of passive? So just to give you some context here, I had the idea to shoot this video after reading the following Financial Times article that was titled, "Can Stock Pickers Fight the Rise of Passive Investors? Active fund managers must prove their strategies are worth the cost." So I have a lot of thoughts on this topic, and I would try to break it down into two major consequences for active stock pickers. The first one would be that markets will become somewhat less efficient. And let me explain this. So I would say, generally speaking, the rise of passive worries some people because they believe this development will eventually harm financial markets. Because if there are fewer and fewer active investors who are really trying to figure out what a company is worth based on the company's fundamentals, well, this will lead to larger market inefficiencies. And maybe for starters, what does a market being efficient or inefficient actually mean? Well, the so-called efficient market hypothesis states that stock prices will always fully reflect all of the relevant and available information, which would mean that, generally speaking, outperformance and underperformance would be impossible. And I could do an entire video about this subject and outline why this premise is just flawed. But generally speaking, I would say the efficient market hypothesis has a point. I would agree that most of the times securities, so stocks, are efficiently priced, and the price they are trading at on public markets are somewhat accurately representing their true, fair, intrinsic value. However, I just said most of the time. So I think there will always be periods, basically in any given year. Just look at the 52 stock chart of any publicly traded stock and you will see that the price actually fluctuates rather heavily. So stock prices are efficient most of the time, but there will always be mispricings occurring along the way. And so why are people now worried that the rise of passive will make markets less efficient? Well, basically, passive money is quote unquote dumb money. It's value agnostic or valuation agnostic, meaning if you buy an index, the index provider will just buy all of the underlying stocks of the index, regardless of the price the underlying securities are trading at. So ironically, passive investors are in a way emulating the decisions of the active investors, those who are actually trying to figure out what a company or what various companies are worth. And I say ironically because many passive investors claim that active investors are quote unquote idiots because they don't invest passively and they believe that they can actually outperform the market, which they think is impossible for most people, which I personally, just on a side note, strongly disagree with. I think if you are passionate about investing, if you put in the work, if you understand some core principles and then follow a clear and proven investing process, your chances of beating the market are actually relatively high. And I teach all of this in a mentorship program, by the way. So if you want me to teach you how to do that, feel free to reach out to me. Just take a look at the comment section or the description box down below. Now, what I will say, I think the worry about the market becoming less efficient is somewhat valid. Of course, what you have to realize is that not only the passive money is dumb money. Now, if we look at the incentives and the underlying philosophies and strategies of the actively managed funds, you also notice a shift, and I would argue that true quote-unquote price discovery nowadays plays less of a role among active fund managers than maybe did 30, 40 years ago. And this is something that a famous investor, I'm not sure if you heard of him, he's called David Einhorn, has actually articulated fairly frequently in his most recent public appearances. So in a way, this shift within the active fund industry is contributing further to the trend of more and more market participants becoming valuation agnostic. So is this necessarily bad for active stock pickers? No. Of course, in recent years, a number of papers came out because more and more people were warning about this shift. They were claiming that passive investing may lead to a big bubble in the passive investing space, and academic papers apparently found out that, if I remember correctly, as long as something like 10% of the overall trading volume stems from active investors, well then price discovery would still work most of the time and follow rational patterns. And so both active investing and index investing would continue to work. Once we would drop below that threshold, well then I think it would be time to worry, because this would have major implications for both passive and active investors, and we may actually, then slide into a passive investing bubble. But we are quite far away from that point. And so earlier I said that I believe markets are efficient most of the time, but not all the time. And with the rise of passive, I think chances are that markets may be inefficient for longer. And again, this is something positive for active investors. I'm actually looking forward to this trend to continue, because this means I will be able to find attractive opportunities more frequently, and these opportunities will be available to me for longer. So again, just to break it down very simplistically here, if a stock is trading at a price that is far below its actual fair value, this will lead to higher returns for you as an investor. And obviously, you will not find these opportunities all the time wherever you look. Now, it requires active looking, it requires patience, but if you have more of these opportunities available to you, obviously this will be positive for your long-term performance as an active stock picker. And I would even argue that in addition to the development that we have just discussed, so the shift from active to passive, there are other developments that will further contribute to there being more opportunities for the active investors. Let me just mention two here. So I think one is the rise of social media. So seemingly market panic can spread faster and market sentiments can change more quickly. And the second one would be the rise of digital solutions. So the rise of investing apps basically allows investors, retail investors in particular, to make transactions by just swiping your finger. And I would argue that we can see both of these developments, so the rise of social media and the rise of digital investing apps, further contributing to markets becoming less efficient, was already reflected during the 2023 Silicon Valley Bank-induced bank crisis. And I've actually recorded a video in which I discuss why I believe bank runs nowadays are much more likely than they were in the past. So again, the rise of passive combined with the rise of social media and digital investing apps, well, I think this is something that active investors should embrace because I believe it will provide more opportunities for them over the long term. However, it will also require more patience because if markets will take longer to realize the true value of securities, well, you also have to be a little more patient. Maybe you will have to extend your time horizon, your investing time horizon even longer. But if you can do that, you will most definitely be rewarded. Now, earlier I said I think there are two consequences. The first one was that there will be more inefficiencies. And I think another consequence for active investors is that they will have to place more emphasis on management teams. Of course, if markets, as I just said, take longer to make sure that securities trade at their fair prices, there's actually another player in markets who can make sure that you get a return from your investment. So you do not only have to rely on other investors figuring out the true value of stocks. No, you can also rely on management because the way they allocate the profits the company is generating can also have a meaningful impact on your returns. And I've actually done an in-depth video on this specific topic. I'll just make sure to link it in the description box down below, and maybe I'll also link it at the end of this video. But the general idea is that if a stock is significantly undervalued, management can make sure that you see a very positive and high and market-beating return if they, for example, choose to distribute a fairly high dividend to shareholders, or even better, if the stock is, as I said, significantly undervalued, buybacks may actually be the superior form of capital allocation that can deliver spectacular returns for current shareholders if the security is significantly undervalued. Alright, and that's actually already it for this video. Make sure to watch some of my other videos next. Take care.